Portfolio Builder members, welcome to your weekend update. The market will close in 40 minutes, and we are reviewing our track record, our strategy in 2020, headline risks, the top news, and more. In the past 13 months, with no more than a 1% total loss from the start of the month to the end of the month, we've generated 17.68% return. That is a very high return versus the low risk and the goal of our program. So first and foremost, I will protect capital, and then we will worry about generating profit, not the other way around. And that's why our strategy does so well over the course of time. To review, we play the SPY ETF in our equities portfolio number 1, Monday, Wednesday, Friday. That is the biggest chunk of capital at 40%. On Thursdays, we played the bond market, which is the TLT ETF, the U.S. Treasury 30-year bonds, and now they just introduced 20-year bonds after having closed out that product since 1980. And then we have two smaller portfolios, which are the metals and the emerging markets, which is traded in equities portfolio 2 for emerging markets. And then we dabble in precious metals and Bitcoin in the metals crypto portfolio, which is currently the highest returning but has had by far the most volatility. Now, if I do scroll down a little bit, we can look at our total return if you do overlap all the strategies, which is by far the safest way to play the markets and to be positioned to take advantage of opportunities as they arise. Currently, I'm long stocks, long gold, and short bonds, and we'll go over exactly why in this video. The trade that we are currently in over the weekend is a modestly bullish SPY trade. We have a married put under our emerging markets, and we have a married put under our GDX. The TLT we're betting down on with a bearish inverted option caller. So we hit our target return of 1% for January and may outperform our 1% goal this month. In the course of 2019, we had a single losing month, and that month we only lost 1%. Now keep in mind, in the S&P 500, you had negative returns in December, May, and August, drawdowns of 17% and 7.5%. And in our portfolio, we actually had profits in all of those months. So we do make profits in multiple directions. And you'll find I like to be bearish whenever possible and defensive whenever possible. Currently, that's not the case, as the Fed has promised to keep printing money through April. Now, if we do scroll down in the track record, we can look at the returns in the SPY. And my expectation is for the SPY to rally to 360 approximately. Now, recognize that is a guess. I'll give you some background on why I've made that target when we go into the charts. But the Fed's going to begin tapering down the expansion of the money supply after April. So by May, June, or July, I would be worried about a serious sell-off. And at the same time, I believe the yields will have risen significantly in treasuries. So we're going to have a double whammy hitting markets at the same time. You could argue they are trying to engineer quite a stock crash mid-year and potentially for the excuse to go into the next round of rate cuts. Now, if we do look at the SPY track record separated, I do want to point out that we've only had 3 losing months, negative 1.2 in May, negative 1.1 in July, and negative 0.9 in September. So for most buy and hold investors, they did well in equities last year, and I bet they're feeling pretty confident going into 2020. My bet is that confidence is eroded when we again get a massive sell-off that will be short-lived by mid-year. And perhaps the S&P 500 will rebound back to the highs we approach in the next few months, but perhaps not, as we are going into a very vicious election where we have one of the richest men in the world competing with Trump, and that's Michael Bloomberg, the 5th richest American, and he's buddies with Bezos. So quite frankly, I wouldn't be surprised if they alone engineered some chaos in the markets near the election. So if I do a good job for investors this year, we should be able to generate the same boring 1 to 3% return on the SPY, regardless of direction, because I do have a pretty clear prediction of what will cause the stock market to sell off. And again, we'll take a deeper dive into that in a minute. The next portfolio we will evaluate is the equities portfolio 2, played on Tuesdays, which is now exclusively trading emerging markets. What's so important about emerging markets? It represents China and its colony. If China is not growing, the global growth story is done, and the stock market rally will be short-lived. Also, our prediction for bond yields to rise is a bad one. So if we don't see that our equity portfolio 2 is at least to a degree keeping up with the returns in our SPY portfolio, that will spell a repeat of 2018, where emerging markets crash, U.S. equities rally, and then crash, and the big bid is into bonds. Now, I do think that China will rebound because they can manipulate their GDP numbers with a closed economy, and they set their own prices. So it's very easy for them to print just about whatever they want. Plus, we have this trade agreement that insinuates U.S. banks will come in and help them fund trillions of dollars of investment to build the Belt and Road Initiative. So if that's really the case, their $200 billion a year purchase agreement is peanuts compared to what they'll be getting back in terms of loans to build out this next gigantic multi-trillion dollar, in fact, $4 trillion infrastructure project just to get started, where they're trying to take over Eurasia. Okay, next we're looking at our precious metals and cryptocurrency portfolio. We have approximately 8% in gold, 1% in Bitcoin, and 1% in Ethereum. And the key item on the cryptos is to take profits when your position goes over 1% and add to the position when it goes below 1. And in this manner, you'll never have too much exposure to those very volatile assets. The same is true for gold. In our portfolio, we currently have a married put underneath GDX, or rather above GDX. We bought the in-the-money put, which allowed us to lock in a maximum loss of 2.5%, with the potential, in my estimate, to return anywhere from 10 to 20% on this asset, which is 10% of our total portfolio, or just under that, by February 28th, when our put does expire. In terms of predictions for precious metals, if I'm correct and that the Fed does not cut rates until we have a stock crash, and that stock crash happens somewhere in Q3 or Q4 of 2020, then quite likely precious metals has a good year on decent quantitative easing, which Fed calls not QE, and then a great 2021 and 22 when we do real rate cuts to zero and begin real QE, which I believe can happen in 2021 as a U.S.-China trade war is reignited as they combat the terms in Phase 2, which gets into much deeper territory that will be harder to resolve than a simple purchase agreement. Now, if I'm wrong and China is really going to crash in the near future, then we want to be ready for rate cuts sooner, QE sooner, and a big rally in gold sooner. So that's why we do remain long precious metals, even though I think that we might see a better return, at least in the first few months, in stocks going into 2020. The bond market should have rising yields on the long end of the curve. That's our bet. It works like clockwork without failure. When we have a stock crash, the Fed's reaction is to cut interest rates. When we get out of a stock crash and start to see a rally in stocks, that's usually accompanied by quantitative easing. So that's the 1-2 punch the Fed does. The banks know the timing, and it signals for them when to buy bonds and when to buy stocks. In both instances, they're going to be buying when they're cheap and selling when they're expensive. So we'll be doing our best to copy their strategy. If they are going to continue the playbook as they always have, then bond yields rise as quantitative easing goes into the full effect for most of 2020. They're talking about tapering off the not QE in some time frame around April, May, June. So if we really believe that, and then they allow this repo debt to roll off, then this could be a head fake in terms of quantitative easing. If we don't believe the way they are painting this quick fix picture and believe that they will have to continue QE throughout most of 2020, then in fact, our exact plan should play out perfectly. Now, the big picture is the U.S. government has a 2-year budget that locks them into massive spending that cannot be paid for by tax receipts. So as long as that stays intact, it's going to max out our banks who have to buy the U.S. debt by law, and that in turn freezes up the overnight lending markets, which would crash stocks in a heartbeat. So I believe the Fed is trapped in a period of QE and rate cuts for the next several years until we find ourselves back in a 0% interest rate world, and they move from buying the front end of the Treasury into the notes and the bonds. Here's a look at our open positions going into the weekend. Now this is the trade alert we just closed out today, where we had sold the 332 call and purchased the 326 put. And so your action today was to roll that position into the short 333 call and to buy the 330 put. So we did tighten the option collar from Wednesday through today to try to lock in these profits. If we do get a sell-off, then we have very little to lose, $150 maximum or $1.50 a share, after collecting a considerable profit today of $2.12 per share. Now, keep in mind we have Martin Luther King Day on Monday, so this trade does hold us through until next Wednesday, a little bit longer than normal. Tuesday we'll roll over our emerging markets position. Our TLT position is currently up considerably. We'll hit our maximum profit if the TLT falls to 136. This is what we've coined the inverted option collar. The announcement overnight, which really helped push the TLT lower, was the introduction of a 20-year treasury. Currently, there is only a 30-year treasury, and the TLT only holds 20/30-year treasuries or bonds. This was discontinued in 1980 and is being reintroduced after they were debating over a 50-year and a 100-year bond. So the 20-year should be very popular and carry a nice premium over all other bonds available in the government bond space. And here again is that married put strategy on GDX. And once again, we bought the in-the-money put. That means we recognize the maximum loss the second we place the trade, and our hope is that GDX will go up more than the cost of the put option during the period. So we have until February 28th. We can lose up to 2% in this example. And I believe GDX could easily appreciate by 10 to 30% over the same period. So this is a similar trade I'm ready to put on for the bulk of 2020. And we'll start to shorten the duration so that we can chase the price and lock in profits better once we do see hints of rate cuts or real QE. So right now, rate cuts are off the table, and they're doing fake QE. So it's not quite as bullish for gold. But once we get signs that rate cuts are near and real QE is around the corner, that's when we will put on more risk into this position. Buy the more frequent put options at less of a premium and take on a little more risk in this position. Here's a look at our Tuesday trade playing emerging markets. And you can see once again it's the married put, but because I do expect that we should have some pretty rapid increases in emerging markets, that we should be buying a put option every week and trailing behind emerging markets. That way, whenever there is a sell-off, we will have locked in the rise and not have all the volatility in our portfolio. So again, the difference here, after collecting a 75-cent profit, we're seeing a little less of a run up today, but again, we are buying the cheap put option, and we're buying it weekly because I'm expecting a quick move up in emerging markets going into 2020, and it's that same married put. Now on GDX, I'm buying longer duration because I think GDX could actually possibly sell off with all the euphoria around stocks and then only rebound later on in the maybe in February as they see the QE continuing to pile up. So it's kind of the difference between those two trades. Okay, now we're looking at charts. This is the SPY ETF. My prediction is just generally for it to travel higher as the Fed is forced to expand its balance sheet. The analogy I like to give is if there are 10 of us in a circle and there's two stocks, if we all had combined $100, the value of those two stocks is probably $50 a stock. But if all of a sudden the Fed decides to give us all an extra 10 bucks, now there's $200, well, the relative value of that stock probably going to double to 100. So that's the calculation being used by investors as they watch the Fed's balance sheet increase ever since September. So what happened in September to cause this massive stock rally? Was it really the phase one trade deal and all the optimism? Or was it something else? So certainly the phase one trade deal news was shifting money out of bonds into stocks on trade hope. But the real big mover has been the Fed's balance sheet increasing because the U.S. government is creating debt that it cannot sell to foreigners, so primary dealers are forced to purchase this. And that's why we've had repo madness. JP Morgan finally ran out of cash buying up treasuries, and now they can't loan anyone money. So the Fed has to buy those treasuries from JP Morgan so that they can continue to fund markets. So my expectations is for, first, the U.S. government to continue printing out debt. 2, for that debt to be picked up by banks while yields are too low, causing yields to rise. And 3, for the Fed to continue buying the debt from the banks to prevent a credit crisis or a financial crisis. So if that's the case, our outcome is quite simple. SPY must travel higher and TLT must travel lower. And so we're seeing that exact correlation occur ever since we went into quantitative easing back in September and removed the trade war off the table. So my prediction is that we will see the TLT potentially sell off to 120, which if I can zoom out, you can put that into perspective. So we can see just as of 2017 and 2018, normal interest rates for Treasury bonds was in this 112 to 128 range. So 120 is just right there, dead smack in the middle. And again, I think those yields will be so attractive that it will cause the stock market to take profits, which will potentially be quite elevated on the SPY, and to grab up the safe yields in the bond market. So the lower the TLT goes, the more attractive bond yields become. And there's a double payday when bond yields get too attractive. Number one, the yield's great just in itself. But then if you can predict that it will cause a stock sell-off, we know the Fed likes to cut rates during stock sell-offs. So if we do get a stock crash caused by high yields on U.S. debt, then we can predict that they will cut rates, and that will skyrocket the TLT, potentially past that 150, or rather 148 high that we saw in 2019. Now, they like to plan this all alongside crises, so most likely phase 2 trade talks will be the crisis, and this could all roll out right around the election. I'm expecting we see a stock crash towards the year end accompanied by rate cuts and then going into full-blown QE into 2021. And now we're looking at emerging markets. How does emerging markets fit into all of this? Well, it's critical. This all revolves around a trade truce with China. And now they're really, if you read between the lines in the China trade talks, everybody's like, wow, I thought we were only going to get agricultural purchases out of China. Now they're going to what? They're going to reduce the trade deficit by $200 billion? How did we get to that point? But what they are talking about is the U.S. banks coming in, buying bad loans from China, and most likely fueling their Belt and Road Initiative. So American banks, which are obviously multinational banks, are wanting to get their hands on this big infrastructure build-out going into 2020. This build-out alone could certainly save the global economy and help China expand its debt even further than current. So if we believe that's the intention of this trade deal, quite frankly, I believe the Chinese will be happy to reroute $200 billion worth of orders a year to secure trillions in loans for their Belt and Road Initiative. If that's the case, emerging markets could really scream higher, outperform the SPY. And to be blunt, if it does not, then we really have some trouble ahead and need to rethink our entire 2020 strategy. So from that standpoint, there's a huge potential return, one, and then two, if we're wrong, it's going to let us know on a daily basis that we need to rethink that China is going to really stabilize its growth and not put the entire world into a tailspin. Here we have GDX, that's the gold miners. We can see the last time we did real QE was after a real stock crash. First, they cut rates into the stock crash, and then they did the massive quantitative easing, and that made GDX go from something like 16 all the way up to 64. Now, my expectation is this is going to go far higher this time around when we do real quantitative easing and not fake quantitative easing, which is where we're currently at. Now, clearly, the rate cuts in 2019 and the quantitative easing beginning into Q4 of 2019 and into 2020 is having a bullish effect on precious metals. But if we don't end up in a period of more rate cuts and real QE, you might see something a lot like this play out once again. Somewhat of a head fake for the gold market. So that's the big concern and why it makes sense to play gold in the manner of which we are. And that's to have the put option constantly below so that you're essentially doing a bet that you can have a bigger rally versus your downside protection and have very low volatile returns while catching the big move. So my thought is that we are really stuck in a position where rates will never go higher and that the next move is to zero and that there will be a real QE because the government is creating so much debt. There's not enough buyers to service this load of debt we're putting out to the world. So that is my base look at the deficit problem, and it's not just in the US. We're seeing the Chinese, Japanese, and Europeans are in the same boat. So for the entire trading plan to work out perfectly, we need a few things to happen. One, we need to see the Fed's balance sheet continue to grow and potentially past April, even though they're signaling they may try to slow that down in April. One. Two, the dollar needs to weaken. If the dollar is strong, that creates havoc in emerging markets and signals there's no true recovery in China. And once again, I don't want to be short the bond market if the dollar is rising. And we're seeing it start to weaken. So far it looks good, although the most immediate move has not been one of which is showing weakness. And clearly over the past week or so, we have seen the SPY greatly outperform emerging markets, and we've seen the dollar rise. So again, that's just a 2-week window. We'll have to keep a bigger time frame open to really judge the dollar. The big argument that the dollar will continue to rise despite all the easing from the Fed and money printing is that there's so much debt denominated in dollars, and the interest being paid on those debts is creating such a demand for the dollar that it's greater than the amount we're printing, and thus the dollar will continue rising. And so that is certainly a major concern, and one which has been made popular by Brent Johnson with his so-called milkshake theory, that the dollar's sucking up all the crappy currencies and converting it into its good currency. Okay, so what else could go wrong and cause losses to the portfolio? Well, the big reason for the stock rally has been stock buybacks. And I think Apple, for example, has bought back something like 10 or 20% of its open float, and so have many companies. So that is dramatically increasing the earnings per share, as they're essentially burning shares so that the real shareholders earn more of the profits. And how are they fueling the buybacks out of profits? No, they're borrowing at low cost. So we have a few credit markets we can watch in the corporate bond space, namely of which are AGG, LQD, and HYG. AGG is by far the largest fund in the world for corporate debt and is U.S. debt. So we can also look at similar ETFs in different markets outside the United States. Big picture is it has tightened slightly, but not much. And so this does correlate a little bit with the TLT, although we will see that the corporate bond market's really a partner of the stock market and a competitor against U.S. government debt. So we'll talk about that in a moment. But bottom line is corporations can borrow money, no problem, and there's no end in sight. So let me zoom in. We can see that credit is cheaper than ever relative to almost any period in history for almost any large-sized public company. What about your LQD? So this is your investment grade. Same picture. In fact, at least last year, Microsoft and other companies were able to go into Europe, where they have negative rates at some of their central banks, and they were able to get negative corporate debt. That means Microsoft will get paid to borrow money, and then they're turning around and buying their own stock back. So until this crashes, good luck getting Microsoft, Apple, Amazon, Google to go down for a substantial amount of time. Well, what about some of the weaker companies? Fair enough. We can go look at HYG, the same thing as JNK. And certainly the junk bond market does look weaker, but in the grand scheme of things, credit is cheap. And in the short term, it's rallying to even lower lows on yields and higher prices on the bonds. So we're seeing a lot of the bad government bond money looking for yield and flowing over to junk bonds right now. So this helps fuel your Russell 2000. And if we get both the big companies like Microsoft, Apple, etc., Google to rally, plus we can get the really the middle of the stock market, the Russell 2000, to also rally because they have cheap credit, well, then you can get quite a stock boom. So things are looking very good for U.S. stocks from all of these perspectives. Okay, now we're looking at BNDX. This is a huge international corporate bond fund, and you can see it's really never been better for international bonds. So they have access to cheap capital. A similar one is the Emerging Market Bond Fund. So this is getting a bunch of those Middle Eastern countries, and relative, it does look a lot like the emerging markets chart, kind of flat and going nowhere. But if the U.S. banking system's coming into China and helping them finance the Belt and Road Initiative, I'd suspect these rates continue to get cheaper. And also we're seeing money get out of sovereign government debt, which has super low yields, and searching for yield in stocks and in junk bond markets. So I suspect this will continue to rally higher as well, signaling that really, if you are a company that's publicly traded, you most likely have access to capital to fuel your business or even to buy back your stocks. And this is a case that we see without exception at this point in time. Another good indicator or warning signal ahead of trade war conflict has been the Chinese yuan strengthening, or rather weakening, devaluing against the dollar. And currently it's strengthening rapidly. And this is even with the forecast that there will be no tariffs rolled back in 2020 until a phase 2 trade deal is signed. And the Chinese are saying they have no interest in signing the phase 2 trade deal. All they really wanted to do, if we really read into it, is buy $200 billion a year of our goods in exchange for what does look like about $1 trillion of infrastructure loans for their Belt and Road Initiative. So phase 2, quite likely, will be a problem, and we'll see how hard that's really pushed in 2021 after we have potentially developed some massive improvements in our economic ties to China. Now, if you are in our boot camp, you know I'm dying to short this currency, as I do believe conflict is around the corner, and that will force the Chinese to devalue their currency further. Now, I do like to look at other country index ETFs, particularly the Brazilian ETF and the South Korean, as they tend to give us a little bit of a heads up of moves in the stock market before they happen. Now, it's not 100% accurate, obviously, but when we're in a period of synchronization, where we are really in a period of peace, and everything's supposed to gel together, they should be correlated. And so if they break paths, that once again will go back to the global growth is not coming and make us rethink how we play the bond market. But currently we are seeing a pretty serious uptrend in the Brazilian stock market. If we zoom into a daily chart, we can see this big rally it's had. Over the last, really since September, we've seen it jump from 39 to as high as 48.50. Now, South Korea is home of Samsung and a whole bunch of exports, so they're super sensitive to global trade, and another great leading indicator for stocks. And so far, it's pointing up as well, so that's a healthy sign. Okay, now in this chart, we're comparing the dollar index versus some specific dollar pairs. And you can see the big picture is that over the last 5 years, and even further, you could go back a whole decade actually, but over specifically the last 5 years, we've seen every currency under the sun, except for perhaps a couple pegs that just track the dollar, like the Hong Kong dollar and the Singaporean dollar. But other than that, we've seen every other currency really devalue significantly against the dollar. And this was all caused because of a slowdown in Chinese growth in 2015. So the big question is, can they get out of that slowdown? And I believe the answer is yes, with massive stimulus that must come from outside of China. So we'll see if that really plays out with this U.S.-China trade deal or not. But if we do zoom in, we're seeing the big picture reverse course, and we're seeing the dollar weakened, not weakened, as these other currencies strengthen. So we're starting to finally see the dollar lose its strength, which is critical for all of our predictions going into 2020. So once again, this is something I'm closely tracking. If you're in the Jeffrey Gundlach, Ray Dalio, Stanley Druckenmiller camp, you believe the dollar will weaken this year. But if you're in the Brent Johnson milkshake theory, and there's a number of people up that same alley, they believe there is such a shortage of dollars and that the European area is in such utter disarray that there will be such demand for the dollar that it cannot weaken, and this will cause countries to print money, to exchange it into dollars, to pay their interests, and continue the run-up in the dollar. So depending on what really happens to the dollar will really make massive changes in how our portfolio should be designed and calculated to generate. Okay, in this chart, we're looking at the long end of sovereign bonds for a host of countries. At the very bottom, we have the German 30-year yield at 0.29. So think of that. You loan money to the Germans, and you're going to get paid 30 basis points, 0.3% a year for 30 years, which is clearly under inflation. So why would anyone buy that? Because they think rates will go lower so they can flip it to the German central bank for a profit. That's the only reason you would buy that. So that's the first one. But the point of this really is to get a feel for what direction the long end of the yield curve is headed in other bond markets, other large bond markets, and to try to get a feel for where the 30-year Treasury is headed, because that's one of our biggest positions. In fact, 40% of our portfolio is trying to predict the future moves on the 30-year Treasury. Now, the Fed did come out with the 20-year Treasury, so we'll be lumping both of those into the TLT, but the same basic concept applies. So we have two big things happening at the same time. Number one is we clearly have investors who simply want to own sovereign government bonds, and they want the yield, the best yield they can get. So from that perspective, the U.S. really has very little competition. We have the Italian bond sitting right above ours at 2.42, but our 2.2% interest rate is a lot safer than the Italians, or at least it comes across that way to global investors. After that, it really drops off to much lower rates. We have the 1.79 in Australia, the 1.68 in Canada. In France, you get 0.87, and in Japan, you get 0.45. So if we look at the landscape of where you'd put your money, if you really were just looking to buy government debt and earn a yield, well, there's really no competition outside of the U.S. Okay, so that's the first thing we need to recognize here. So that's one. But two, other governments obviously know that, so their yields most likely will start to head towards our yield if there's not a crisis around the corner. So if I thought the German economy was about to crash, I would love to buy that 0.29 yielding 30-year bond, because I know in a heartbeat they might push the yield even lower and I could flip it for a profit. But if I have a different outlook, and I believe there will be growing in 2020, that the China story is going to fix itself, well, no longer am I going to risk buying that 30-year German bond, as if it does rise in yields, I'm going to be stuck with a big loss and no yield. So those are the two big decisions that are happening in people, and these are big banks, pension funds, some retail investors, some hedge funds are trying to make that decision. Do we think we have a global growth story? And if that's the case, can I just buy bonds and create a profit? And if so, which specific country might lower their rates the lowest, because then I'll get the biggest profit? Or do I think we're going to have rising yields, and I just want to slowly buy into that so I can have consistent income for a long period of time that's greater than inflation? So that's why I believe we don't see the TLT just crashing instantly. But if we do look at what's been happening over the course of time and compare these, we can get some feel for it. Okay, so there you go. We can see these yields have been in a period of crashing overall, but magically, like clockwork, right around this pinpoint right here, yields have begun rising. So what happened exactly at that September? Well, it wasn't the phase one trade deal, as many would want to believe. It's actually when the Fed began quantitative easing. And so without failure, we have a very consistent pattern. If the Fed is cutting rates, then these interest rates will fall. And if the Fed is doing quantitative easing, stocks rally and rates rise. It's just as simple as that. As the Fed takes money out of the bond market, it increases the money supply, and in turn makes the value of stocks rise. So as long as we believe the Fed will not cut rates anytime soon, and they typically won't cut rates unless they think there's a recession or a stock crash either developing or in the near future. So right now, with yields this low, it's really hard to believe that there will be a stock crash or a recession. So most likely the biggest fear for the stock market will be simply when the Fed stops QE, which they may not do until after we get a stock crash. So again, I do believe this yield will travel higher and that we will continue to see these rebound. And I think this is short-lived. My best bet is somewhere around Q4, maybe as early as Q3, we get the stock crash and we get the Fed cutting rates once again. So I do think we will see lower interest rates on all of these, but not until 2021. Okay, moving along, this is a treasurydirect.gov. It gives you the upcoming auctions. This gets a little technical for many, but if we can keep track of what percentage of the debt's being picked up by non-primary dealers, that will give us an indication as to when the Fed's balance sheet growth will slow down, and thus the stock market returns will slow down. So from one standpoint, interested in that, the only debt the Fed's going to pick up permanently, at least, is the T-bills, which are in this section. And that's happening on a weekly basis at a very consistent quantity, like clockwork, and is slowly growing over time as the deficit by the U.S. government's getting worse and not better. So that trend is predictable. At the start of each month, typically, they will sell really the cream of the crop, the primo of all debt in the world, are these bonds. So obviously no issuance for the rest of the month. But we could potentially see a lot of the shock absorbed by the bond market and the 30-year Treasury towards the front end of each month. So I do keep a close eye on that, as well as how these auctions are. Chart of the Federal Reserve's balance sheet, and you can see after the drop in the balance sheet last Friday, which was alarming. And I think they did that because they knew there was some good headline news this week to help support stocks on its own, that they could get away with a little bit of a pullback in the balance sheet. So the few times we've seen some volatility in stocks are these rare times in the last few months when the Fed's balance sheet has decreased. So again, this is the primary driver of markets. And it's not something you can rely on for very long. Again, they are already signaling this will slow down by April, as I think they're going to let the yields rise and, again, get the foreign investment to take over this debt. So the U.S. can really whipsaw markets around and cause pain. And we've seen them do so in a lot of different ways, whether it's cutting rates, hiking rates, really just changing the direction of the markets and catching other markets off guard. So I believe the market that's being caught off guard right now are all the government bonds, the big markets like in Germany and mostly in Europe, where they have super low yields. And now that there's not a crisis in China, their yields are far too low to attract investment. And so the U.S. is going to slowly but surely gobble up all of the bond money in the world as our yields get higher and higher and super attractive, especially to big pension funds and big central banks. So again, if we do look at the bigger picture, 2018 is when they reduced the balance sheet and crashed all global markets. So 2018, during this period right here, where they did their rare reduction in the balance sheet and they hiked rates, we crushed emerging markets. We crushed cryptocurrency first. We crushed gold. We crushed everything under the sun. And eventually we crushed ourselves. Don't forget the Christmas massacre. That was all fueled from the yields rising. Let's go look at the... Okay, so now I'm looking at the yield curve left to right. Over here we can see the duration of the U.S. bond and up and down the interest rate. This is a healthy yield curve. You essentially lend at one rate and borrow at another, and that's how banks like to make a profit. So if the curve doesn't get more expensive the longer out you go, the banking system doesn't work. And so let's see what caused the Fed to create changes that are massively changing the outcome of the markets. Okay, so we go back to August of 2018. We had a extremely inverted yield curve. You got paid much more to borrow in the short term than you did in the 5-year, 7-year, 10-year, even the 3-year yields, which was Stanley Druckenmiller's big bet in the at his December Bloomberg interview 2018. So a lot of people like to follow his trades. Perhaps the greatest hedge fund manager of all time, at least for macro style trading like I like to do, and not so much James Simon, artificial intelligent, rapid fire computer trading. Regardless, what does the Fed do? Well, they had to get that front end of the yield curve lower. What better way to do it than pick up all the debt issued at those 3 rates and force the rate to where they want it? Okay, so that's when repo madness began. That's when quantitative easing began, or like they call it, not QE. They began growing their balance sheet, and you can see they sure as shit force that rate lower, and the reaction is that the long end of the bond market has been rising, and so have stocks. So I believe this trend will continue so long as they continue to buy the front end of the yield curve and do quantitative easing. So again, that does seem like the opposite of what would happen, but it happens like clockwork and has been repeated throughout history. It's the Fed's playbook. Cut rates if you think you got a stock crash problem, and do quantitative easing if you think you have a bond market problem. So that is indeed what happened, and what I believe will cause the next crisis will be when these yields get so expensive that it does cause trouble for stocks. So we had a bond problem right now, but the bond problem will probably create a stock problem, and that is due to yields rising, stocks going way too high, and then we get everybody jumping ship from stocks mid-year, perhaps. I think it's really just all dependent on when we see that yield rise. Let's go back to the last time stocks really crashed, 2018, and it was leading into October. We'll just go to October. And what happened? The 10-year Treasury hit 3.15, and that cracked the stock market right in half. 2 things. One, that's a great yield with no risk. It's greater than inflation, so put 10 times leverage, you're going to make a great 10% return a year with almost no risk. So anybody with common sense would want to make that bet. 2, if you believe it's an attractive bet, it could cause a stock crash, well, then you know what the Fed will have to do. They cut rates when there's a stock crash. So you got a double payday potential, a risk-free return for 10 years on the yield, and then A, and then B, if we're correct and it's so attractive it does cause money to jump ship from stocks into bonds, then you can anticipate the Fed will cut interest rates, which makes the value of your bond go up a lot more than 10% and instantly. So now you can flip your bond a couple months later for a big profit. Now let's see, did that play out? And again, they switched course in September when it went inverted. But holy smokes, if you bought that 10-year Treasury in the top of the stock market in 2018, when that yield got above 3, boy, oh boy, you made a massive profit as the yield fell to 1.5, making the value of your bond appreciate probably about 25%, maybe even more. So that's the thinking behind why the high Treasury yield could crash the stock market at some point in 2020, and why I'll be more inclined to call a top in stocks as the 10-year approaches 3. Now, there's more debt, there's more problems now than there were the last time we had this occur. So I do believe it won't take 3% or 3.15% to cause problems, but perhaps. All right, guys, so we've gone on for quite a while. Let me go ahead and close out this video. We didn't have time to really focus on the news flow or the impeachment. Those are some wild cards that we should be concerned about. The China trade deal is a concern for sure. If the primary dealers have less of a burden on the U.S. debt, then that's a concern for stocks. And really, those are my primary headline concerns. We have the developments in the Middle East. We've got the North Koreans. So there's certainly some wild cards out there. That's why I appreciate having a put option at all times under all assets and trading on this frequent basis. So if things do change, we'll be ready to make the appropriate moves. Thank you so much for your time. Do us a favor, like the video, subscribe to it, leave a comment, and we'll see you.